Okay, this is chapter 2. We're going to go over week 1. We basically went over the users of accounting, what accounting is, and a little bit about financial statements, but we'll hit that more in depth here. So, analyzing business transactions, section 1, property and financial interest. This is basically going to be saying, also known as assets equals liabilities plus equity. We'll see here property will be assets, financial interest will either be liabilities or equity. Those are claims on these assets or the property. So here's our objectives. So we'll record the equation of each of these transactions and see how they affect the account equation. Define, identify, and understand the relationship between assets, liability, and equity accounts. So these are the different types of accounts we'll see, and as we'll see, owner's equity accounts they will have subcategories like revenue, expenses, paid in capital when you're dealing with a corporation. But in this chapter, we're actually dealing with a sole proprietorship and a service business. So, and we're just going to find out the financial effects. So, Wells Consulting is the example. It's a firm that provides a wide range of accounting and consulting services. So this is a service-based proprietorship. Carolyn Wells is a CPA. Carlos Valdez is the office manager of the firm. So we're just giving a little background here. Customers paying cash when services are performed. So when we provide services, we either, and you'll see in the chapter, either debit cash, or we can either debit cash or accounts receivable and credit revenue. That's how we record revenue. So first steps we have to do to analyze a business transaction is describe the financial event. What are they doing? Are they paying something? Are they getting something in return for, whether it be on account or paying cash? Usually the first transaction in a company is the contribution of cash, so, and we'll see that later. So identify the property, identify who owns it, whether it be a creditor or the actual owner, determine the amount of increase or decrease, and make sure the equation is in balance. So as you'll see, whatever we do to this section, we'll have to have a corresponding, so if we increase assets by $100, this side will either increase. You'll either increase a liability to a creditor or the balance of the owners, which is basically called equity. So here's an example. Carolyn withdrew $100,000 from her personal account and deposited it into the new savings account of her business. So the analysis is the business received $100,000 of property in the form of cash. Wells has a $100,000 financial interest. So see right here, 100, 100, these equal. So that's the analysis. This is something in some textbooks called called transaction analysis. So with that transaction, we can see property and financial interest. The property is cash right now, which we're going to expand on as we do more transactions. And the financial interest is, excuse me, capital, Carolyn West Capital. So we invested cash 100 here and 100 here, and our new balances are 100 and 100 respectively. We are in balance. We are in balance. Property equals financial interest. So keep note of this, and we'll on the next slide they should be on the top over here as carried over balance. So she now has 100,000 equity in the business. Carry over our previous balances. Now the company buys equipment for 5,000 cash. We spend cash. So again, we're going to learn journal entries, and that's going to be the basis for the rest of the course. This is transaction analysis, and we're just getting you used to see what increases and decreases. Still important. So we spend 5,000, so we're decreasing an asset or property, and we're also increasing it. So basically on this side of the equation alone, we have an increase and a decrease. So we're decreasing here from 100 to 95 and increasing here. That equals 100, this equals 100, we're in check. So we balance. Company buys 6,000 of equipment on account on credit. So here's the previous balances. We're getting new equipment for 6,000. We're not paying cash yet. We're basically saying an IOU to a creditor. So that comes down as a liability. So when we foot all this all will equal 100,000. So 100,000, I'm sorry, uh, 106,000. So this part, the property, is this, and the financial interest is these right here. So we're in balance. So notice the new creditor claim on the firm's property. So creditor claims and owner claims equal financial interest. Purchase supplies from suppliers. Well, the firm purchases supplies for $1,500 cash. So we're just dealing with left side over here. So we're subtracting here and we're adding here, and we fit down here 106. So we bring the previous balances over. Firm makes a payment of $2,500 on account. So we're buying something. We bought something in the previous example. Now we're paying down that balance. So that IOU is now due. So out of the $6,000, we're paying $2,500. So we can see here we're decreasing our cash, and we're also decreasing our liabilities, which is good as well. We're in balance. Firm makes a payment of $8,000 rent in advance. So we're spending $8,000 and we are debiting, or we're increasing an asset of prepaid rent. This will eventually, as every month passes, as time passes, we'll learn later in the class, adjusting entries. So as time passes, this prepaid rent will get decreased, and we'll have prepaid expense that will go on the income statement. Right now, these accounts are all on the balance sheet. These are all balance sheet accounts. We're in balance. So here, objective 2.2, assets, liabilities, and owner's equity. What are assets? Assets are simply property owned by a business. And we saw examples of this: cash, accounts receivable, supplies, equipment. Those are all assets. Liabilities are debts or obligations to a business. Previous example, we saw accounts payable. Those are obligations. Equity, sometimes referred as the residual claim. So owner's equity is a term used by sole proprietorships. It is the financial interest of an owner of the business. So basically, whatever assets minus liabilities should be the residual, so to speak, and this will be your equity. A balance sheet. So different types of financial statements. Creditors use them, internal employees like managers use them, investors use them. Balance sheet is basically a period of time. Think of it as a snapshot. Think of a balance sheet, and you'll see from reading the textbook, definitely read the textbook first before you get to these lectures. The balance sheet is, think of that like a picture on your phone. It's just, you hit the button, just one snapshot in time. Think about holding down that button and taking like 50 pictures, and you'll have kind of like a time lapse. That's through a period of time. Think of that as the income statement, or kind of like a movie. So the income statement, say the balance sheet is for 12/31/16, you'll have the income statement for the whole year or whole quarter. Say if it was for the whole year, it would be from 1/1/16 to 12/31/16. So all those 360 days, 365 days, that will be the income statement. So here's an example. So we have here assets, total assets. We add up cash, supplies, rent, equipment. That's going to be total assets. Amount and types of property owned by a business. Liabilities are the amount that we owe, and the equity is the owner's interest. Notice that, and this will always be the case, no exceptions, whether you're taking accounting 1 or accounting 4, advanced accounting, total assets will always equal the total of liabilities and equity. So we'll foot over here. And this is the whole basis for the accounting equation. Assets will always equal liabilities plus owner's equity. Or property will always equal financial interest. Financial interest, again, is two components, and think of that as liabilities plus equity. So analyzing business transactions, we'll do a little bit more on this. So the effects of the business transactions of the assets, of the firm's assets, liabilities, and equity, and how we're going to record those in accounting equation form. Then we'll prepare an income statement and owner's equity statement. So you have basically three main income statements. Well, I'm sorry, three main financial statements. Actually, four if you include the cash flow. but in this chapter we're just going to deal with the three. The first one, you'll always have the income statement. The net income from the income statement will always go to the second financial statement, which is the owner's equity statement. We need the net income to find out the ending balance of owner's equity. That ending balance of owner's equity will follow, and you can make the balance sheet from that. So it's always income statement, owner's equity, balance sheet, always in that same order. That's how you prepare those financial statements. So what is the fundamental accounting equation? That's basically the relationship between the assets and liabilities plus owner's equity. Those will always equal. The assets will always equal the combination of liabilities plus owner's equity. So in accounting terms, the firm's assets must equal the total of the liabilities and owner's equity. The equality can be expressed in an equation as assets equals liabilities plus owner's equity. So the entire accounting process that we deal with, whether it be analyzing, recording, reporting, it's all based on this concept. So once you mentally know this is the only equation you'll actually have to memorize, and it's going to be beat into you, so I wouldn't worry about that. If any two parts of the equation are known, the third can be determined. For an example, you just say you have assets of 10 and you have liabilities of 6. You can kind of play with the numbers. This would be 4. So it's kind of, you can do that with any numbers. Just try to think in simple terms. So if you have 2 liabilities and 2 equity, you'll have 4 in assets. To the effects of the transactions in the firm assets, liabilities, equity. So what is revenue? A revenue is a component of equity. So basically a revenue is an inflow of money or other assets that results from the sale of goods and services from the use of money or property. It is also called income. This could be a little tricky. I would try to stay away from calling it income, because in an income statement you have revenue, then you have expenses. So revenue minus expenses equals net income. So it's kind of confusing if you start with income instead of revenue. So income, expenses, net income. I'd rather have income, focus on income on the bottom of the balance sheet, bottom of the income statement, called net income. You can also have a net loss. Expenses. So revenues, expenses, these are found on the income statement. An expense is an outflow of cash, use of other assets. So remember that example we had for use of other assets? We had prepaid rent. So just say you have prepaid rent for 6 months and you paid $6,000. At the end of month 1, you can take 1/6 of that amount, and that amount will go on the income statement as an expense, and the balance sheet prepaid will be reduced by that amount. So that's the use of other assets. That's an example right there. So the firm receives, when we go back here, go back to the transaction analysis, firm receives $36,000 in cash for services provided to clients. So basically, they provided a service and their customer paid them in cash. And there's not another way we can record this. If they didn't pay in cash, it's more of an IOU. So remember, the accounts payable was an IOU to our creditors. Sometimes our customers, we provide a service and we bill them later. That process, we record that revenue before we receive that money, before we receive that cash, and how we record that will be that accounts receivable. So we'll come to that later. But right here, we perform services, $36,000, we receive cash. We also increased owner's equity by earning revenue. So in the owner's equity portion, we had capital. Now we have a component of capital. This will eventually be closed out to capital through the closing process, but revenue is $36,000. So the combination of this, liabilities plus equity, will always equal the combination of the total assets. Again, that's what I mean by beating this into you. Assets equals liabilities plus owner's equity. Good examples in the text. The company performed services on account for $11,000. So this is what I was talking about. So the same example as before, but instead of getting cash, we're basically saying, hey, we're going to bill you. And when we say we're going to bill you, we record an accounts receivable. And you'll see later on, when we receive cash, we'll add cash and we'll subtract the accounts receivable. So we're in balance here, bring the previous balances, collection of $6,000 from customers. So exactly. So we're going to get $6,000, and we're going to decrease the accounts receivable. So perfect example, one after the other. So right now we're just increasing assets and decreasing assets by the same amount, and basically we have the same we have the same totals as before. Firm pays $8,000 in salary expense, so you have employees, you probably want to pay them. So we decrease cash, and we record this as an increase in expense. Although we're paying the money, don't think of it as a negative. I mean, we subtract expenses from revenues, but we're actually tallying up this account. So we're going to increase it in expense, and we're going to decrease our cash. So think of this is a good reminder of, okay, here's a visual of what this sentence says. Again, transaction analysis. So we're paying another expense. We're paying utilities. So we subtract $650 from cash. We have $116,350, and we're adding our expenses here. Here's the previous balance, and here's new balance. We are in check. We are in balance. Okay, you're the owner. You want to take out money for your personal expense. That's the whole benefit of having a company, right? Is to spend that money. So we subtract cash from the business, and we're going to reduce capital. We're going to decrease owner's equity. So there's a couple ways you can do it. You can decrease capital, or you can increase something called drawings, and that later gets closed out to capital. Either way is fine, as long as you can see money's going out of the company here. We are in balance. What is an income statement? So we basically went over this a little bit in detail. Income statement is a formal report of a business operations covering a specific period of time. Keyword here, think of that as the movie. Remember that example with the holding your thumb on your phone button and how it takes like 50, 60 pictures. The first picture being day 1, the last picture being, I don't know, day 30. Let's call it a month income statement. So the balance sheet is one snapshot in time. The income statement is for all of the operations that the business performed from the first of the month to the 30th, or for the first quarter from January 1 to March 31st, half a year, or a full year. So here we go. This is a good slide. So like every financial statement, you're always going to have the who, what, and when. The who is the company, the what is the actual statement, and when month ended December 31st. Another way we can write this is we can put, since it's month ended, we can put 12/1 or December 1 dash December 31st, as long as the reader knows, hey, this is what was for basically 30 months of activity, or 1/12 of the year. Usually have revenues over here, but I don't know what happened. There we go. So the income statement reports revenue. So we have 47,000. We have salaries expense, utilities expense, total expenses. So this is just aggregated from here. This is subtracted from here. So 47,000 minus 8650 equals 38,350. That will be net income. You'll have brackets here if this number was bigger than that number. So here's your expenses. There's your net income. So we made the income statement. So that net income was right here. So this is the capital balance on the balance sheet. Here's Cameron Wells capital at the beginning of the period. So just say December 1st or 11/30. So for the month of December, the net income was 38,350. Remember, we took out 5,000, so we subtract the withdrawals. And this is labeled an increase in capital of 33 because the net income was more than the withdrawals. If the withdrawals was above 38,350, we'd have a decrease in capital. So since we have an increase in capital, we add that to the 100, and we have 133,350 for the ending balance. Now we can make the balance sheet. See, we have the who, what, and when over here. So we have the assets, cash, accounts receivable, supplies, prepaid rent, equipment, total assets, 136,850. The accounts payable, and these are the actual transaction analysis entries that we looked at before, same numbers. So, and I think it came from the textbook. So go back through these slides, and you can see that these will foot, these exact figures will foot. So liabilities plus equities will equals 135. Total assets equals total liabilities plus owner's equity. So what are the importance of the financial statements? Who needs them? Why? Business managers and owners use the balance sheet and income statement to control the current operations and plan for the future. Definitely plan for the future. So you can have So at the bank, we do projections and budgets. Okay, what'd you do this quarter? What'd you do this month? Okay, let's take a 10% increase and do that month over month. And you can certainly different ways you can budget that way. But that's how we would use that internally. Externally, creditors have to approve you. So in order for you to pay on account, so if I'm in this consulting company and I buy copiers and paper, and I have bad credit, they might not extend credit to me. Extending credit means, if they don't extend credit, that means you have to pay cash. If you do extend credit, they're basically saying, okay, you have 30 days or you have 60 days to pay me. That's all dependent on your credit rating. And they look at your financial statements to base that rating. So creditors, investors, if you're a public company or even private, government agencies, certainly the IRS, they want to know how much money you made, so they can define how much tax you need to pay. So here we go, financial statements prepared in a specific order. You'll have the income statement is always going to be first. Net income rolls into the statement as owner's equity. Remember, you have beginning balance, add net income, subtract any withdrawals. You have the increase or decrease, then you have the ending balance. You take that ending balance and you can make a balance sheet. And here's a good visual of that. So, and this is in the text as well. So we have the 3 lines, 3-line heading, income statement, this month ending, statement is owner's equity. So this is a period of time, and it's that snapshot. So we have net income, this rolls out over here. We use that to calculate our ending capital balance, which rolls down to the balance sheet. And so that's the end of chapter 2. So if you haven't already, please go ahead and read the text, and certainly these examples here will help with your homework. Let me know if you have any questions.